Welcome, I'm Jay. This is smarthelping.com. We're going to go over the cruise ship slash boat tour financial model here. It's a 10-year model. Don't be afraid of the big numbers. This model is very robust. You could use it for a smaller boat tour, yacht tour business. It doesn't have to be a giant 4,000 person cruise ship, but it can be. Um, and we're going to go through, I'll tell you all of the assumptions and all the tabs, explain how everything works, and then you'll know how to use this thing. Link in the description box below to purchase the template, and I'll also post it on the vendor sites. So first tab index just gives you a quick overview of each of the tabs. If you look at global control, this is where you can define the name of the company. This will flow to the financial statement at the top. The launch year, and be careful when you change this launch year, it will affect all the drop downs. So you want to go through all the yellow tabs, and anywhere there's a drop down, you want to make sure that your number makes sense now that you've changed the launch year. A lot of people forget the debt schedule, um, or they'll forget to change these numbers if the launch year changes or any timing changes. You need to make sure you're paying attention to that. You could choose the exit month. So any month chosen here will stop the whole forecast, and then you could choose on that month if there's an exit or not. If there is, there will be an exit value based on a multiple of the trailing 12-month EBITDA per the exit month. So you could do this as a 5-year forecast and just stop it after 5 years or whatever. It doesn't matter what time you enter here, and that'll just define how long the forecast runs. It will go up to a max of 10 years. Next, and notice, as you can see, you're only going to be editing the cells in light yellow with blue text, and that will ensure and guarantee nothing gets broken. You also want to go through these forecasts like you're actually doing it, so really pay attention to what you're entering. Treat it as if you're trying to build this forecast for your actual situation and look at every single thing that is relevant, and the forecast will work beautifully. Next, you've got the month cruise launches. This is just for depreciation. So what this means is if you're building a new cruise ship, you can't start depreciating that cruise ship until you actually launch it and start using it. So this is how that calculation starts right here. This will not affect anything else. There's other dynamic logic for when cruises actually start happening, and the number of cruises and ticket pricing, all that will be defined on the ticket revenue tab, which we will get to. Next, cash sources. This is just to show you, are you going to take out a construction loan or development loan or acquisition loan? If yes, then this will populate here, and you'll have an option for a development loan that'll last for some amount of months here. For the number one here, just make sure this matches your first draw month, whatever that might be. It'll line up with this development and acquisition schedule, which we'll get to um, in a second. But yeah, the debt schedule, if you're going to use debt, it'll come in here. You can see here we have, let's see, I think I did 8 months worth. So you can see the draws happening here, the interest charged. You can accrue it as well and not have payments, but then that'll just flow over to the regular P&I loan at the end of the construction term, whatever that is. This is all dynamic. You can determine the interest rate here. If there is no construction loan and you're just financing like a purchase, that's fine too. And if you're doing that, you would just make sure this month and this month are whatever interest only period. You just put as 1, and then the start month of the loan could be any month, whatever it is. And then you could put as 0% for the interest rate. In that case, you'll have whatever you ended up borrowing will go, or whatever you end up drawing will just no interest accrues, and then at some point, in this case, month 5, you're rolling it into a regular P&I loan with its own term, amortization, interest rate, and all of that. And note, if you do define an exit period here, then if you are including terminal value, it will pay back the loan automatically. If you don't include the exit value, then it'll just keep running, which is fine. The model will stop at that month, but it's not like it'll show your debt balance, but not that you're repaying it. Okay, let's put this back to how it was. There is also an option for one refi to happen over the life, and that'll just be based on LTV and a multiple of EBITDA at some future month. And you don't have to do this either. You can set it right now. It's yes in month 36. If you put no here, it doesn't happen, and then the regular P&I schedule just goes down through here. We'll put this back to yes for now, just for the default. We'll give it interest rate back here, and we are not accruing. Okay, so that's the debt source. If you're doing debt, you hit yes. The other sources are equity. That amount actually is going to be built on the cap table. So the model will solve for the minimum equity needed based on all of your acquisition and development costs, any other startup costs, and any burn. The total equity you need to keep cash above zero will show here. And then I've simplified this cap table. So default, this will show any equity needed beyond what the owners or operators are putting in if it's a joint venture. If it's not a joint venture, and you're not bringing on investors, it's just the owner's money, you would put the whole amount here. You just copy, paste values only into here, and you can see this overflow zeroes out. You would also have to zero out their equity and put 100% for the owners, operators. But if it is a joint venture, you're raising money from different investors or different founders, you'd put the amounts in here. Any remaining amount that hasn't been accounted for would flow to the overflow, and you need to put the percentage of share they're getting. So we'll put this back. Right now, it's basically saying they're contributing 61 million for outside investors, and they get 40%. Owners are contributing 10 million, and they're getting 60%. Now these numbers are arbitrary, but you can put it at whatever you want. There's checks down here to make sure you've zeroed out and you haven't entered too much or too little amounts in these boxes. All right. So and then that cap table data will come in and fill in the total equity required, and then how much the investors are contributing and their distribution rate, and how much owners are contributing and their distribution rate. Note, I do have a optional waterfall joint venture built into this as well, where any negative cash flow month is a contribution, any positive cash flow month is a distribution. There's a rate here for LP and GP, and then there's hurdles. And you can define how the cash is split up to the LP earning certain hurdles, 11, 15, and 20. And you can modify all this. Here's all the logic for each tier. Here's the summary of each tier, and it goes out for 10 years. There's also a discounted cash flow analysis and an annual summary for the LP and GP. So that's built in. It will change as you change all the assumptions. But you don't have to. This doesn't have to be a joint venture. And again, all the model will do. The main focus is creating a way for you to put in, okay, here's how much it costs, here's what the operations look like in the cash flow, and then if I exit, here's what the exit looks like. That is all the baseline, and then all these other tabs are built around it to show various financial things, measures, and reports. And there's a 3-statement model connected. We'll get to that. All right, so, and you do have income tax, capital gains tax you can enter here if you want to see after-tax cash flow, and then here's sanity checks as well to make sure all your reports are matching up. These should always be 0. All right, so next tab, development and acquisition. This is where you're putting any costs you have to get the ball rolling, get construction started. You can enter those costs each month. There's a bunch of schedules here for you to enter that in. Obviously, there might be land if you're buying an island for the cruise. So you can enter all that there. And then next to each item, you can enter if it's financeable or not, yes or no, and if so, how much of it is being financed, and that's what flows to your debt schedule. Any remaining capital that's not financeable will flow to the equity requirement. Depreciation, you can just put the useful life of each section. So each section here is summarized in one row. These are the sections from this tab. So all these sections are just summarized in total here. And you can put the useful life, and then based on that start launch month, it'll start depreciating at that future month. You can also put any sales proceeds if you're selling, if these are like hard assets that aren't really counted in the sale, but there's some value it's separated from the total selling price of the business, then you could enter a number here and it will populate in this box. In this case, it's a loss, so that will affect the tax cash flow if you're including taxes. If you're not, then this loss has no effect. It's just a tax thing. Now, if we were to sell it for more, like 160, then there's a gain here based on this value relative to the book value, which is after all the depreciation has happened against the initial cost basis. Okay, so there's that. Now the meat and potatoes, the ticket revenue. So how are you going to make money? So I did a monthly schedule on this. You can see here in column E, you're entering the number of cruises that are being taken per month. And these all are automated based on your assumptions from the control tab, which is just the timing in the month number, year number. So you enter the number of cruises per month, the average cruise length in days. You can see the total days at sea essentially per month. This is just kind of to help you make sure you're putting in assumptions that are realistic and make sense. The distance per cruise. So this is, you're going to want to put the average distance you're traveling per cruise per month, and that will define fuel costs. Here in column J, you're putting the number of tickets sold per cruise on average. And then you're putting the percentage of those tickets that are of up to 10 different prices. So this could be different room rates, different pricing packages, what have you. You don't have to fill them all out, but these should equal 100% however you do fill it out, because it's based on whatever this total is. You're just defining how much are of this type of ticket, this type, etc. And then once you have done that, you would fill in the price of each type of ticket. Now this here, so you're saying like ticket one, you've got 5% of these tickets are ticket one, and that costs $1,200 per ticket. This number here, I built a helper calculation. So if you have different cruises you're taking each month and the ticket price is different, then here you can see I'm looking at ticket price one, and I'm putting all the different types of cruises there are that could be taken in that month and the different prices of those, and that will give you your weighted average. So if I take 3 cruises, 2-day cruises that are $500 and 2 10-day cruises that are $1,500 a ticket, then my weighted average in this case would be 900, which is just weighting the price and the count of cruises that are happening in that month. So this 900, you would then go into your ticket revenue and populate right here. Because we're just trying to get a sense of, based on all these tickets and how many cruises are being taken per month. You know, in this case, if we were selling 5,000 tickets a cruise, we took 2 cruises in the month, that's 10,000 tickets. You're just trying to figure out, well, how much am I making with ticket price 1 or package 1 tickets, and etc. And it'll multiply that all together. So that's that logic. You can change these pricing over the full 10-year period by month. These are ancillary calculations. You can see count of passengers per ticket type, and this is just taking the total percentage by the average ticket sold per cruise. You've got ticket revenue, which is taking the total count of passengers by type times the price times the total cruises per month. And then you've got the total, this is your total ticket revenue essentially. This will be broken down on the monthly detail as well. So that's how you define ticket revenue. You've also got onboard purchases. So as a cruise, you might have casinos, spas, art, shore excursions, and you could define for each of these, you know, the percentage of passengers that partake in the activities. And like if we look at the first one, alcohol, we have 20% of passengers doing that. You do the average spend here in this case per passenger, average margin you're making on alcohol, and that'll give you your cost and profit per passenger. This number and this cost number will flow through to the financial statements. Same goes casino gambling. There's no direct cost here. It's just percentage of customers that do that and their average loss. You've got spa treatments, same deal, the average spend and percentage of passengers doing that one. Art and jewelry, same deal. You've got a margin, you've got percentage of customers doing it, and the average spend per customer that does do that. And then based on this, you can see the average cost as well per passenger based on what they're buying. So they're buying $300 worth of stuff. It costs the cruise ship $51 to buy those things, to give them or to provide those things, and then you've got $250, $49 in profit per passenger for that revenue stream. And then shore excursion, same thing. And I put in a percentage here. You could zero these out if there is no direct cost, but if there is, you can put it in here. This would be like if they're paying a travel or let's say bus line company some amount per passenger and they make some margin on that. You could, define that here. Staffing. So here you've got all your staff to run the cruise ship. You got your count, the month they start, and the position type. The start month might be all the same for everything. The starting salaries, payroll tax and benefits, and increase. And then based on that, you'll see data here. If an item starts in the year 2, then this base amount doesn't start till year 2, and then it starts increasing. You've also got other staffing positions to account for, outsourced talent, no payroll tax and benefits for them, and then other outsourced professionals in that schedule. For other costs, we've got standard operating costs. This would be maybe legal fees, food costs if you want to put it here. There's also a dynamic schedule for food costs below, which we'll go into. Supplies, just general, insurance, anything that's a fixed monthly cost that you have not accounted for elsewhere, you can put into here the starting amount, expense increase per year, and that'll flow through. Now, also on this tab, you've got fuel. So you've got the average mileage per gallon. So here's 0.025. It depends on the cruise ship, the size, and a bunch of stuff, but you can put that in there, the average price per gas. That will give you your fuel costs, and the calculation happens over in the monthly detail. You've also got food costs here. So if you want to break out, per cruise, how much are you spending on average for all these different food types? And here's the total, and that will just multiply by the cruises taken per month to give you your total food cost per month. And again, I've just put in arbitrary numbers here. You would research and put in your own data based on your scenario. You've also got one-time onboarding and offloading costs. So depending on how many cruises are taken per month, you would multiply that count by this for onboarding and this for offloading. If it's not relevant, you can zero it out, and that is fine as well. What else? CapEx. This is any other items you want to purchase that are depreciable. You can put in here that will flow through to the equity requirements. Nothing here is subject to being financed. Only items here are. So if it's depreciable, you want to put it on here. If it's potentially going to be financed. If it's not, then and you want to put it on this schedule, you can. Cap table we went over. Terminal value. The only thing here is just a tax calculation. You could put how much of the total sales is going towards extraordinary income versus capex. In this case, we're going to put this at 100% because we're not looking at any of this. If you do have items here and then the sale price, you might want to allocate some to the cost basis if you have any left on this tab. If not, you've got, obviously this is already happening here separately for the acquisition or development cost basis, depreciation, and the resulting profit or loss. Terminal startup costs, any other startup costs we haven't said that are not depreciable, you could put into here. Also a reserve, this would, the higher you put this, it basically says when the balance sheet says you have zero cash balance, this is actually the amount you would have. Debt schedule we went over, benefits calculation. Okay, income statement. So here, based on all our assumptions, we can see ticket revenue, onboard purchase revenue, total revenue, our variable costs, gross profit, OPEX, EBITDA per month, interest expense, all the depreciation, taxable income, actual income tax, net income, and then you can see this goes all the way over. Here's our exit, and there's taxes on that as well. We go to income statement annual. Here's that. Balance sheet. You've got your cash. So in the first 7 months, you're essentially just funding exactly the amount of equity you need, and you're not making any profits here. So retained earnings is negative, cash is zero, and then you start making money here in month 8 when cruises start taking place. So you've got some revenue happening and some savings. Accumulated depreciation, assets equal liability plus owner's equity. So you got all that calculation happening here. Here's your debt balance over time. Balance sheet annual, same deal, but on an annual basis. You've got cash flow monthly. So here's your operational income or operational cash flow, investing activity cash flow, and financing activity cash flow, and then total cash flow per period based on all of that. And here's the annual version of that. This is kind of like your sources and uses, but it's a little bit more advanced because you're looking at a formal cash flow statement. Okay, what else do we got here? Distributions tab. This is your discounted cash flow analysis for the project as a whole right here, and then the investor view and owner view if there's any outside investors versus inside investors, discount rate, and this just looks at the monthly cash in and out, and then it applies it to the investors and owners based on all the assumptions we already talked about, and then you've got an annual summary of that happening right here for the LP and GP, or the whole project as a whole would be this row here. Visualizations, revenue by type, annual EBITDA, cash flow, and cumulative cash flow, annual revenue versus expenses. Let's put a legend on this. Balance sheet cash by month, assets, liabilities, and owner's equity over time, EBITDA versus debt service. We're not showing the ratio in this one. Oop. Executive summary, you got your high level items, revenues, gross profit. This is kind of like the income statement, but we're also showing other items here. Proceeds from exit, loan proceeds, debt service, CapEx. So you can get the whole picture. You've also got project IRR, investor IRR, owner IRR, total equity required by each, total cash returned, equity multiple, and total ROI over the period. We've got revenue and EBITDA charts here as well. Now the monthly detail, here's where you can actually see by month what is going on. So development, acquisition. Here's your revenue details, total tickets sold by type, total ticket revenue, onboard purchase revenue by type, total revenue, variable costs, all those variable costs, gross profit, all the OPEX items, in-house staff, all of these items. Oh, that should be formatted like this. Outsourced professionals, other overheads, then you've got EBITDA, earnings before interest, tax, depreciation, amortization. Evaluation based on EBITDA multiple. This is just for the refi if you're going to have a refi in the future. Startup costs, CapEx, financed amount, cash flow before financing. Then here's all your financing cash flows. So you've got proceeds from the draw of the interest only, construction loan, interest payments. Then the P&I loan starts here. Then we got a refi happening here and cashing out a little bit, and then cash flowing after that. Then you've got your exit where you repay the loan. Exit proceeds are down here, but you got your total cash flow happening in then row 262. So you can really see every single aspect and how it's affecting cash flow over time. This is a 10-year model, 10-year view. Here's the annual view, which is the same thing as the monthly, but on an annual basis. I did group these, so if you wanted to only see high-level rows, you can do this and basically almost see the whole thing, well, almost all the way down to EBITDA without having to scroll very far. Then you've got all your other cash flow items and cash flow here. So you can expand or minimize that by pressing the one or the two. Here's the optional cash flow waterfall. We kind of went over this. You got hurdle rates. This is essentially your preferred return if you have an LP or a partner that has, preferred equity, and you can define how that's split. It could be pari passu, meaning the LP gets in a GP split it based on how much they've contributed, and up till the LP gets a certain IRR, and then after that it splits differently. This is a promote, and this is a more advanced structure, but I did put it in here because I think it potentially, could fit some cases, and I didn't want to leave any possibility out. And then we got the annual waterfall summary for the LP and GP. I already kind of showed you this, but this is total contributions and then total distributions and a visual. Validation tab just has the months. Base factor, this was for the previous template basis I used this for. So this is not relevant for revenue, but all these are still relevant. This is to calculate outsourcing, increase in price, base factor for salaries, base factor for revenue. And that's pretty much the whole model. Trying to think if there's anything else here. I think that's it. So again, and you could, the main test I do to make sure all these calculations work is change the end month and change if there's an exit or not, and then make sure these are always 0. That gives you a good idea if everything's working. And it looks like it is. Okay. I just want to check real quick, make sure we didn't break anything with that last move I did. It doesn't look like anything's affected. Those are just old calculation references that are not used in this version. I did use the assisted living template as a shell, and I built all the revenue and cost assumptions into it. So that was a very good one. I'm really happy with how that works, and that's why we have that stuff on the validation tab here. Okay, well, I think that's it. If you want to purchase template, the template is going to be a $45 one-time fee. You'll get it right after purchase. And if you're into finance or building financial forecasts at all, this is a very good place to get an out-of-the-box solution. All the formulas are editable, and it's a great way to build professional forecasting reports. All right, that's it. Take it easy. I'll see you guys on the next one.